In just a minute, you're going to need to have this file ready, which we're going to work on the Parker Hannifin valuation model. So I put up a file in Elms. And if you go to Elms, it is called File Section. Under the folder that says PH Model, you'll need the file that says Valuation Model PH Start.xlsx. All right, so the key this week, while you're getting that file ready and open, is that today and Wednesday, we will build out the valuation model in class. And you're going to follow along, creating it as I do. And if you are able to, at the end of Wednesday's class, exactly follow and create what I did, that's homework 6. That's what you're going to submit for homework 6. All right, so it's very important that you have that file ready to go in just a couple minutes as we start working on that model. All right, while you're doing that, let's talk briefly about homework 5. So homework 5 had 3 elements. The first element, let's go back to homework 5, was right here. You needed to calculate an operating ROIC, and again, I gave you a screenshot for Parker Hannifin operating ROIC using BIC's best fit algorithm, a whole firm country domicile market cap greater than $1 billion. So essentially, if you went to Bloomberg and you put that in, and then you typed in operating ROIC, you should have gotten 12.6% for Parker Hannifin, and the industry average would have been 12.91%. Okay, so very quickly, what we have done is we put into Bloomberg a quick calculation of operating ROIC as a custom field, which will go along with what we're doing for the traditional ROIC. Okay. Second thing that you would have had to do as part of the assignment is you would have had to export the Parker Hannifin data file. I again posted that as a solution to, it's in the PH file, PH folder. Files, PH model, basically phdata.xlsx. That's the file that you should have exported. And what's important here is that if you did it correctly, you should have 6 years of historical data for Parker Hannifin in this Bloomberg list, which is going to be very important for the model that we're going to use in just a minute. Okay? And then the final step would have been to do the IBM ROIC tree analysis. So again, assuming that you did the write-up correctly, this would have been the IBM ROIC tree. A little bit bigger, easier to see, but you should have just walked through the tree. Again, for homework 5, I said only worry about the 1st and the 5th year. We're not worried about the intermediate years, but that's only just to get started throughout the semester. We are going to care about the intermediate years. This was just for easier practice. But your paper should say something like this. In 2013, IBM's ROIC was 28.1%. It fell to 8.7% in 2017, a 69% decline. All right, if we look at the taxes, taxes went from 16.6% in 2013 to 49.5% in 2017. So basically, taxes had a big reason for that decline. However, if you look at the pre-tax ROIC, it went from 33.7 in 2013 to 17.2, a drop of 49%. So they also saw some underlying business deterioration. Okay, so it wasn't just taxes that hurt them. If we look at the operating margin went from 19.8% to 13.1% between 13 and 17, 34% decline. So they were seeing a decline in margin. And invested capital to sales went from 58.8 to 75.8 over that 5-year period. So again, a 29% increase in invested capital. So all 3 drivers hurt them. They're paying more in taxes, right? Their margins are declining, and their productivity is worsening. All right, all 3 things hurt their ROIC. As we talk about the second level drivers, gross margin went from, in 2013, 54.2 to 51.5. So that 3-point drop in gross margin was one of the big hits of why the operating margin went from 19.8 to 13.1. SG&A in 13 was 29.7 and went to 32.7 in 2017. So in addition to losing 3 points on gross margin, they lost 3 points of operating margin because they spent more on SG&A. And depreciation went from 4.8 to 5.7 between 13 and 17. So they also spent more on depreciation. So all 3 of the income statement items were working against their operating margin over that 5-year period. If we look at the balance sheet, working capital in 2013 was 9 cents. 2017, it was 10.6. So that went up by a penny. PP&E of sales went from 14.1 to 14 between 13 and 17, so that really didn't affect it. So really the productivity hit was all intangibles. It went from 35.6 to 51.2. So really all of the hit on productivity was goodwill and intangibles. And you can see that the big jump appeared to be in between 14.15 and 15.16. So obviously they made some big acquisitions in those 2 years, and that's really what hurt their productivity while their margins were declining. And that's basically what you needed to say as part of the write-up for IBM. Okay? So just a simple walk through the ROIC tree for IBM. And that would have been homework 5, 3 parts of homework 5. Any questions about that? Okay, so then let's turn our attention to the Parker-Hannifin valuation model that we are building. So again, in Excel, hopefully you've downloaded the file that I referred to. And this is a step that was part of homework 5 that I have done for you. You don't have to do this step for today, but you would have to do this step in the future. So if you look at the data tab of the model you just downloaded, as I said, there's a bunch of tabs that work left to right. The first tab is called Model Data. That model data actually came from your homework 5 assignment where you exported the Parker-Hannifin data that's mapping to the model. Now, one step that I did not ask you to do on the homework that you're going to have to do in the future is that when you export data from Bloomberg, sometimes instead of zeros, sometimes Bloomberg will give you dashes where it's missing information. And we're about to put this file into our model, and Excel chokes on dashes if you put that into a formula. So if you use a formula in Excel and that field has a dash in it, not a zero, it'll just error out the formula and it will not calculate. So that's going to become a problem for us. So I didn't ask you to do this on homework 5, but going forward, one of the things you're going to have to do is if you find dashes in your export, which you will, because Bloomberg will sometimes say missing information, just give it a dash. Now we'll treat it as a zero. What you're going to have to do is replace the dashes with zeros. So basically, you basically go to find, which is either Control F, or you can go to edit find, and then replace. So you want to find the dashes, okay? Or an easiest way is to copy and paste a dash into what you're finding, replace 0, replace all, and that will replace all the dashes with zeros. Now, in this file, I've already done that, but that's something that you're going to have to do as part of your assignment going forward. All right? Because, and again, don't do this today, but what we then do is we would take the file you just exported, we'd select the whole tab, once you replace all the dashes with zeros, we'd go to our model that we're going to build today, we'd right-click, paste special values, hit OK, and basically what we're going to do is we're going to overwrite Parker-Hannifin with whatever company we happen to be working on. So for example, if this were Boeing, we would export to Boeing, the Boeing file, we'd replace the dashes with zeros, we'd copy the Boeing data, we'd overwrite the Parker-Hannifin data, and now our model's ready to do Boeing. All right, you don't have to do this. I've already done these 2 steps, but that's actually what this file came from. It came from your homework, and this is a very important part this semester of files that we will continue to reuse. This is what builds a reusable model. So as I mentioned last week, from here it creates the standardized income statements and balance sheets, which create the economic statements going through CFI and economic profit. Now, 2 additional tabs I want to talk about that I didn't talk about last week. So again, the model works from left to right. So one of the tabs is called assumptions. So here's a best practice for building a model. You want to minimize where you put your assumptions that you change over time. Because if you build a reusable model and you scatter assumptions throughout, I guarantee you'll forget to change something somewhere in your model and it'll frustrate you. You'll be like, this doesn't make any sense, and you just have some assumption buried in some tab that you forgot to get to. So best practice, minimize where you put your assumptions. For purposes of our model, we're going to have a tab called assumptions, and this is where we're going to aggregate all the assumptions that we will start to change. This list will continue. The other thing I've done is I'm using color, and I picked yellow arbitrarily. You could use, I've done that over the years, you use whatever color you want, but to highlight what cells we can change in our model going forward and what cells we cannot change in our model. Because there are so many formulas and relative references that we're going to build out, we don't want to break our model by accidentally overwriting something. And right now, because we're building our model, I didn't lock down any of the tabs. So you can go in there and you can destroy the model by accidentally overwriting things. So because we're going to build this model, what I've done is I'm going to start to highlight things that we can change using color. And again, I've chosen the color yellow versus things that aren't in yellow we don't want to change because we don't want to break our reusable model going forward. So that's just a convention that I'm using. All right, so these will be assumptions that we'll start with that will move on over time. Okay, and I'll just give you one quick example. So if you look at the income tab, the last reported year for Parker Hannifin, they're in their fiscal 2019. So they just reported 2018. So here's the deal. I go to assumptions. I change next year. They report their 2019 data, hit enter, and I go to the income tab. Now this year is 2019, not 2018. This is what I mean by building a reusable model. And I don't want to accidentally overwrite that because if I ever change that assumption, I want to flow through the model. So yellow, change in assumptions, all the other places refer to that, and then the model gets updated accordingly. Okay. Again, don't do that now. I'm just giving you an example of what the model will eventually do. Now, the most important part of the model, and this is where we're about to start today, is called the ratios. So these are historical income statement and balance sheet ratios that are generally a percentage of sales with the exception of revenue growth rate and tax rate. And I alluded to this last week, but I'll mention it again today. Best practice for forecasting is that if we're going to forecast financial statements, we forecast ratios. We don't forecast numbers. Right? You actually get a better forecast by forecasting the ratios. So that is the process that we are about to start. And again, we want to use relative references where possible. So let's start building the model. Again, you're going to start with this Excel file that I just gave you. And if you can follow along with me now, by the end of class, you're pretty much done with most of the homework. And then we're going to pick up where we end class today on Wednesday. Again, you follow along and create with me. And if you're able to do all that in class, you've completed homework 6. You can submit homework 6, okay, at the end of class on Wednesday. If not, you have until 10 a.m. next Monday, week from today, to get to where we end up at the end of class on Wednesday. All right, but it is your responsibility to build this model yourself. Okay, no sharing of models. So for purposes of seeing everything on my screen, I'm going to hide some of these historical columns. Not delete, because I'll screw up the model. Hide. You don't have to do this. It's just my screen is small, and I want you to be able to see what I'm doing from left to right. Okay, so I'm going to hide some of the historical years. So we're going to build a forecast for Parker Hannifin or any company that is arbitrarily going to be 5 years. Okay, so we're going to forecast 5 years of data, and year 6 is going to be what's called the continuing value period. All right, now 5 years is arbitrary. We have to forecast the future for a company. All right, 5 years is probably not enough. All right, we probably should do 10 years. All right, and the ideal amount is you want to do at least a business cycle, or you want to do it until a company becomes mature. All right, that's really when you want to be in what's called continuing value. But for simplicity, we're just going to do 5 years. And as the book says, another best practice is however many years you forecast, you always forecast an N+1 year, which is the beginning of the continuing value period. So since we're forecasting 5 years, we need 6 years of data. If we were to forecast 8 years, we would need 9 years of data. If we were to forecast 10 years, we need 11 years of data. Because whatever that final year is, N+1, that's the beginning of our continuing value period. So the first 5 years will be what's called the defined period, year N+1 continuing value. Okay? And again, I want to make it a relative reference. So here's where we're going to start. For cell H1 in the ratios tab equals the previous year plus 1. So that's how we're going to iterate a year. Okay, just relative reference, year plus 1. And then for the revenue growth rate, last year they grew by 18.9%. So as a placeholder equals the previous year, we're going to assume the growth rate stays the same, at least as we're building the model. Later we'll change this, but for now, since I want to all have the same number, equal the previous year. And I'm going to make this a yellow cell because this is something I could change over time. Okay? So let me quickly show you the relationship between the statements. All right, so if Parker Hannifin were to grow an additional 18.9% in 2019, if I were to go to the income tab, and again, I'm going to hide some of these historical years, we are going to eventually create a forecast equals previous year plus 1. So for H2 is G2 plus 1 for revenue. And here's how we're going to do it. We're going to take, for H3, we're going to take G3, which is 2018's revenue, and we're going to multiply it by left paren 1 plus from the ratios the growth rate in 2019. So H2, right paren. So here's the point. And I'm also going to format all of this as $ to 1 decimal place. So here's the point. If Parker Hannifin were to grow another 18.9% in 2019, its revenue would be a little over 17 billion, 17 billion and 5 million. Okay, so the ratio drives the number. I don't want you to do this, but here's an example. I don't think they're going to grow at 19%. So let's say that it's more realistic that they grow at, pick a number, 4%. Well, that's 14,874.5. So as we change the ratio, again, it will change the income statement. I don't want you to do this yet, because that's what we're going to do in a future class. We'll put in more realistic numbers. But as we're building the model as placeholders, we're just going to leave this. I'm going to undo this, equals the previous year. Okay, kind of set up the process we're about to do. Now, as we forecast the income statement, we're going to forecast the entire income statement. But here's one of the shortcuts we're going to take. The next forecasted item is EBITDA. Equals the previous year, 16.4%. And again, I'm going to make that yellow. Now here's the thing. To get to EBITDA, which is going to be a primary driver of our forecast, we would also have to forecast cost of goods sold or cost of revenue and operating expenses or SG&A. Right? Now, if you're working for Parker Hannifin's CFO is going to want to see that forecast because they're going to care very much about what you think about their costs and what you think about their overhead. Right? But practically, from a cash flow model standpoint, EBITDA doesn't care. EBITDA is a result of those two numbers. So for simplicity in our valuation, we're not going to granularly forecast cost of goods sold and operating expenses. Right? We're just going to directly forecast EBITDA as a key driver. Right? But nonetheless, if you're doing this in the real world, you might actually have to do that level of granularity. But for purposes of the valuation, it doesn't matter. Okay? So again, we're going to forecast EBITDA directly. All right, the next number we're going to forecast is depreciation and amortization so that we can get to an operating income. So again, equals the previous year. So H7 equals G7, make it yellow, which leads to our next line item, operating income or EBIT. So here's the thing. Because I forecasted EBITDA and depreciation, I've essentially forecasted operating income or EBIT. All right, I don't really need to create a third forecast because it's dependent on the two above. Now, I've actually made a choice. We could have chosen to forecast operating income and depreciation and solve for EBITDA. We could have backed into an EBITDA. We also could have solved for EBITDA and operating income and solved for depreciation. All right, so I'm making a choice in this class that we're going to forecast EBITDA, we're going to forecast depreciation, which doesn't change too much often for companies, and therefore we're going to solve for the operating income. That will create the operating income forecast for us. So equals H6 minus H7, 13.2%. I'm not going to make that yellow because, like I said, forecast 2, you get the third. And I don't want to forecast a third based on the other two because then I might actually make a mistake. Okay, that would be the difference between something that will put in color versus something that would not. Everybody see what I'm doing here so far? Okay, our next forecast is the tax rate. So as a placeholder, whatever it was in the previous year, so H9 equals G9, and again, I'll make that yellow. Later, we'll put in a more realistic forecast for the tax rate, especially now that U.S. corporate tax rate fell to 21% this year going forward. So it's obviously going to be lower than it was previously. So again, for now, we'll leave it as a placeholder, 37.7, which gets us to our no plat. No plat is operating income times 1 minus the tax rate. So I'll give you two choices. If you want to be lazy, you can go to cell G10. It's got the right formula, which is operating income times 1 minus the tax rate. So you can copy G10, go to cell H10 and paste it. Or you can type in the formula H8 times 1 minus H9. But basically, and again, no plat is not a yellow cell because it's the operating income and the tax rate get us our no plat as a percentage of revenue. So it's a calculated result, 8.2%. All right? And then the final income statement number we're going to forecast as a ratio is non-operating gains and losses, and again, equals the previous year. We're going to leave those alone. What you're going to find as we build the model is this actually has no impact, zero impact whatsoever on the valuation, but nonetheless, it gets us a balancing income statement. So we are going to forecast non-operating gains and losses. Okay, so that represents kind of the core of the income statement that we need to forecast. Now what we're going to do, that we have these core ratios built, is we're going to go to the income tab and we're going to actually build out the actual statement. Okay, so starting with EBITDA. Oh, sorry, I'll just do a step. Take column H, copy column H, and paste it through column M. So that would also get us an income statement ratio forecast on the ratios tab going through 2024. Okay, so now we have 6 years instead of 1 year of forecasted ratios. We could have done this later, but it'll just make it a little bit easier when we drag the income statement over, that those numbers will be pre-populated. So again, right now, we just have ratios which, again, equal the previous year, just copied forward as placeholders, forecasting out 6 years of the income statement. All right, now we're going to go back to the income tab. We're going to start filling out the income statement. Our next line is EBITDA. So this is a process we're going to repeat. So here's what we're going to do. For 2019, so for cell H8, equals, from the ratios tab, 2019 EBITDA as a percentage of sales, so H6, times, from the income tab, 2019 revenue, H3, that would get us 2792.3. Okay, so if this is our revenue forecast, and this is EBITDA as a percentage of revenue, then that number should be 2792.3. Ratio is H6 times income H3. Okay, same thing for depreciation. For depreciation and amortization, equals, for cell H9, we go to ratios. 2019 depreciation is H7 times income H3. So 554.2 would be our depreciation and amortization forecast for 2019. And you can see over to the left, we have some pluses and minuses here. We now solve for our operating income. Operating income in 2019 equals the EBITDA minus the DA, so H8 minus H9, 2238.1. So very quickly, we put in place a forecast for EBITDA and operating income for Parker Hannifin in 2019, assuming these ratios work out. Questions about what we've done so far? Hopefully you're matching these numbers. Should be easy. Okay, so interest expense. One of the things the book talks about is that when you do an enterprise DCF, you target a capital structure. So for our purposes, we're going to assume the current capital structure equals the target capital structure for the company, which means we're not going to muck around with the debt or equity. Whatever debt or equity they have, we're just going to leave alone. We're going to leave it as is. You're also going to find has no impact on the valuation. Okay, people get kind of uptight about this in the real world, but realistically, it doesn't affect the valuation. So we're not going to try and change it anyways. So here's the deal. Interest expense, whatever interest income and interest expense they have, they're going to keep paying. So if they paid $213.9 last year in interest equals previous year, they're going to pay $213.9 because we're not going to change the debt. Same thing for interest income for H12 equals the previous year. Whatever interest income they're getting, we're going to assume that they get it. Again, this will not affect the valuation. It's really just to build out income statements. Foreign exchange gains and losses, 0. Too hard to predict. I don't know which way the currencies are going to go. All right, and so therefore I don't know how to predict gains and losses for uncertainty with currencies. So I'm going to assume the company's reasonably good at hedging and that they're probably going to hedge so that the FX gains and losses are minimized. So again, we're going to leave it at 0. Now I'll just be really clear. If you're working on a company and if you believe that the number shouldn't be 0 and you can actually reasonably forecast it, by all means, you can go back and overwrite something that we have done. What I'm trying to do is simplify this and focus on things that matter, because FX gains and losses don't have huge impacts on valuations. It's based on the future. forecast of the business if they're not easy to forecast. So we often don't. Okay, so income loss from affiliates equals the previous year. Whatever gains and losses from affiliate income that they have, they're going to keep. And non-operating gains and losses equals, from the ratios tab, 2019 H11, non-operating gains and losses as a percentage of sales, times income tab, 2019 revenue. So negative 40.1. Now, to get to pre-tax income, we have to get the right order of operations here for all these numbers, right? Or if you want to be lazy, you can go to G16, which has the right pluses and minuses, copy G16, paste it in H16. But you should basically get operating income minus interest expense plus interest income minus FX minus income loss from affiliates minus net operating losses should be 2,064.4. Forecasted pre-tax income. All right. The next line item is income tax expense. Assuming we have 2,064.4 of pre-tax income, multiply by ratios, 2019 tax rate, we would pay 777.3 in taxes. Which would then get us income before extraordinary items, pre-tax income minus the taxes of 1287.1. All right. Now, extraordinary items. By definition, an extraordinary item should be extraordinary. Shouldn't happen again. Okay. Matter of fact, there's a good one this morning. It was actually kind of depressing. Bloomberg had an article where we saw it about GE. We saw GE's horrible news. It basically said that between 2000 and today, GE's market value has gone down by $500 billion. An 81% decline in their market value. This is being the most valuable company in the world to the horrible position they're in today, being kicked out of the New York Stock Exchange Dow Industrial Average. And today they fired their CEO and took like a $23 billion one-time charge that is part of another reorganization that they continue to do. This one great company is just a shell of its former self. In fact, Bloomberg was just naming, like, they lost more value than Facebook. Like, they lost more value than certain countries. Like, they were just talking about the $500 billion. It was kind of truly sad. But in any event, that's the point of extraordinary items, is they just took an extraordinary charge today, $23 billion. It's one time. So it's too hard to forecast extraordinary items. They shouldn't recur. So therefore, zero. We're not going to forecast extraordinary items into the future, okay? Because they shouldn't happen. So zero. So therefore, net income before minority interest, we can just fill out the equation, equals the first one, income before extraordinary items minus the extraordinary items, but generally they should be zero, 1287.1. Minority interest. These are dividend payments to minority shareholders. So again, since we're not changing the capital structure, whatever dividends they make to their minority shareholder payments, they're going to keep making. So equal the previous year, which would then lead to net income equals the net income before the minority payments minus the payments to the minority shareholders. Trouble the mouse here. So equals that minus that. Or you could, again, take the previous cell, G22, and copy it over. But again, 1286.5. Next, cash preferred dividends. Again, since we're not mucking around with the capital structure, equals the previous year. Now, Parker Hannifin doesn't have any preferred dividends, but if it did, we're going to leave them alone as to what they're being paid. And then for other adjustments to equity. These are where the accountants have fun with FASB and IFRS adjustments that are basically paper transactions that have no impact on cash flow. Okay, so basically we'll let them do their paper stuff and we'll basically assume in the future it's too hard to forecast what the impacts of these FASB changes are going to be, especially if they're non-cash items. So therefore, we're not going to forecast them. Zero. All right. I don't know what FASB changes are going to occur for 2019 and 20 that'll affect Parker Hannifin, and I don't know what the impacts are going to be, so it's too hard to forecast. Zero. Okay. Net income available to common shareholders. Take cell G25, copy it, and paste it over. Here's why. Normally, you would take net income, subtract cash preferred dividends, subtract other adjustments to equity. But to actually make the model work, we have to add cash preferred dividends and then subtract other adjustments. And here's why. You can see on the next line. For whatever reason, Bloomberg will list a cost of goods sold, SG&A, depreciation, as a positive number. But in this data feed that we get, Bloomberg puts in dividends as a negative number. So if we were to subtract a negative number, it would actually have the equivalent of adding it. Okay? So the same is true for both preferred and common dividends. The feed that Bloomberg is giving us is dividends or negative numbers. So even though we would subtract the dividend, if we subtracted the negative number, it'd be the equivalent of adding it. So I've already adjusted for that in this model. That's why I'm saying copy over G25 to H25, because I already know that even though Parker Hannifin doesn't have a preferred dividend, if it did, it would show up as a negative number. Okay, so I just want to make sure that I get the right order of operations. That's why you also have to check your data feeds when you use other data sources for models, because sometimes the data feed will give you a number in the wrong format, and it can completely screw up your model. So it's just something you have to pay attention to. All right, I have in this case. So back to dividends. Next line equals the previous year. We're going to leave the dividends alone. So again, whatever dividends are paying, we're not going to change that policy. It's the same thing for retained earnings. Normally, we would take the net income minus the dividends. That would be change in retained earnings. However, since dividends are coming to us as a negative number, then equals net income plus the negative dividend is change in retained earnings 921.3. Or you can copy over G27 to H27. Okay, so very quickly, based on the ratios and a few more assumptions, we have created a forecasted income statement for 2019. Take column 19, copy it, paste it over to column M, as in Mary, and you should now have a forecasted income statement that goes through 2024. And if you want to check your numbers, 2024 revenue should be 40,403.2 and change in retained earnings 2875.7. Those are the numbers that you should be matching. Yes, sir. Are we not looking at which one? When you say 2018 estimated where? Yeah, we're just going right to 2019. So again, right now, we're looking at these as placeholders. So since he asked the question, I don't want you to do what I'm about to do because this is a future class. This is where we're eventually going to get. So hint, hint, we need a more realistic forecast for 2019 and 20. Where might we get that? Oh, Bloomberg tool, that's very valuable. So if we go into Parker Hannifin and Bloomberg and we type in EEO, then off of the EEO screen in Bloomberg, we have a consensus estimate for revenue for 19, 20, 21. So if you want to see some foreshadowing, eventually we're going to look for growth rates that are much closer to the Bloomberg growth rates that will get us numbers that are more likely to be the Parker Hannifin numbers rather than the placeholder numbers. But again, I don't want to do that today. So as we're just building the model to be able to get to that level of valuation, we're just using the placeholder equal to previous year. Okay. So ignore what I just did for now. That'll become important later. Other questions? Yes, sir.
Could you click in on cell H15 for a second?
H15?
Yeah. For point one.
So that was a ratio, H11, which was non-operating gains and losses, times H3, which is 2017 sales, or 2018 sales. Yes, sir.
Could you say for income tax H7?
So again, for income tax expense, we're just using the ratio of H9, which was the forecasted tax rate, off the ratios tab, times H16, which would be the pre-tax income. Yes.
I see H20.
H22? 20?
Yeah.
So H18 minus H19 is H20. And again, two things to help you. You can look at the pluses and minuses in column A. You can also look at column G, because a lot of what we're following has already been done in column G. There's one column over. Okay. All right, continuing on. So now that we have a forecasted income statement going through 2024, we need to do the same thing for the balance sheet. Okay, so let's go back to the ratios. As I said at the beginning of class, basically, all of these balance sheet ratios are a percentage of sales. Now, McKinsey and others would argue that that's not academically ideal, meaning accounts and notes receivable as a percentage of sales makes sense, but if we were to do inventory, it should probably be closer to a percentage of cost of goods sold, because that's the driver off the income statement that would drive inventory. And that is academically true. However, for simplicity, we're going to tie everything to sales. And you're going to find that there's an elegant benefit to doing that in our valuation. So basically, we're not following the pure academic tie it to the driver. We're tying everything on the balance sheet, these 9 ratios, to sales. Everything's a percentage of sales. So here's how we're going to handle this for 2019. Equals the previous year. We're then going to make this cell yellow. We're then going to select a range from H13 to M21. And then we're going to paste. Oh, sorry. Got to copy it first. Copy H13. Select the range H21 to M21. Paste. So that basically we have 6 years. Everything is a percentage of sales. Everything just equaling the previous year. Okay, so he's got a bunch of forecasted balance sheet ratios as placeholders for Parker Hannifin. Okay, so here's what we're then going to do. We had to turn these ratios into forecasted numbers. So again, similar process to the income statement. We're going to go to the balance sheet tab. So you can see it on one screen. I'm going to hide. You don't have to do this, just so you can all see it on my screen. Don't delete. Don't wipe out the columns. That would be bad. So I'm hiding these columns. And this is going to be my forecast years. So again, forecast. First year, H2 is equals G2 plus 1. And now we're going to start forecasting out the balance sheet. So again, every one of these ratios is a percentage of sales. So we'll start out with accounts and notes receivable for 2019, which is H13. So here's how it's going to work. We go to accounts and notes receivable as a percentage of sales. So for 2019, so H6 equals, from the ratios tab, H13 times, from the income tab, 2019 revenue, which is H3. So 2940.283. And I'm going to take all these numbers and format them currency to 1 decimal place. All right, we're going to repeat this process 8 more times. Inventory for 2019 equals, from the ratios tab, inventory is a percentage of sales, H14, times income tab, 2019 revenue as a percentage of sales. That should get us 1927.7. Other current assets equals, from the ratios tab, H15 times, from the income tab, 2019 revenue forecast, H3, 161.5. Long-term investments equals, from the ratios tab. For them, it's pretty much 0. Still want to have the math work. For another company, it may not be. So H16 times income, H3. Net fixed assets as a percentage of sales equals ratios, H17 times income, H3. Other long-term assets is the next one, equals ratios. Other long-term assets as a percentage of sales is H18 times income, H3. Accounts payable equals ratios, H19, almost done, times income, H19, or for 2019, H3. Short-term liabilities, other short-term liabilities equals ratios H20 times income H3. And finally, we have our other long-term liabilities equals ratios H21 times income H3. So very quickly, we have put in the 9 items as a percentage of sales that will forecast these balance sheet lines, all driven off of 2019 percentage of sales. Okay, now we have to finish up the balance sheet. We're going to finish up the liabilities and equity side of the balance sheet first. It's going to be very important when we build the balance sheet that we do not have a circular reference. A circular reference in this class, or to be honest with you, anywhere, is an invalid model. Okay, so if you turn in any model in this class with a circular reference, TAs are just not going to grade. So I'm going to show you how to get a forecasted balance sheet that auto-forecasts without a circular reference. Okay, I expect you to follow along. So to do that, we're going to do the liabilities and equity side first. So total preferred equity, we'll start there, equals previous year. Again, if we're not changing the capital structure, whatever preferred equity the company has, we're leaving alone. We're not issuing or retiring any new equity. Same thing for the minority shareholder interest. If there's a minority shareholder, whatever interest they have, we're going to leave it alone. Okay, equal the previous year. Same thing for common stock and share additional paid-in capital. So whatever common shares they have, we're going to leave alone. They're not going to issue or buy back any stock. Equal the previous year. The only thing that will change on the equity side is retained earnings. So the way that we're going to solve for the correct retained earnings is for cell H30 equals the previous year, so G30. So we're going to take whatever our retained earnings started with, and then we're going to add off the income tab, starting in column H, H27, which is the change in retained earnings from the income statement. All right, because we know net income after dividends is how much retained earnings should go up. So therefore, add that in, and retained earnings should go to $61.94. So my total equity forecast for 2019 equals the sum of these 4 items: preferred, minority interest, share capital, and retained earnings. So basically 6786.8. Now let's work on liabilities. Short-term borrowings, that's short-term debt. Again, since we're leaving the capital structure alone, whatever debt they have, they keep, equals the previous year. So if I look at my current liabilities, equals the sum of the 3 above. The accounts payable, the short-term borrowings, and the other short-term liabilities. So we should end up with total current liabilities of $36.81. Long-term borrowings, that's long-term debt, equals the previous year. We're not changing the capital structure. Pension liabilities equal the previous year. Under U.S. law, companies are no longer allowed to add to long-term pension deficits. Pensions going forward must be fully funded, which is why most companies have switched to 401ks. All right? So if you have a pension, you got to eventually fund it, but you can't add new unfunded liabilities. You're not allowed to do that. So therefore, we're going to leave whatever pension that needs to be funded alone, and we're going to assume that any new pension would be NPV 0, right? Because that's what the companies would have to do. So we're not going to add to the pension liabilities. So equals the previous year. So therefore, our long-term liabilities equals the sum of the 3 above, long-term borrowings, other long-term liabilities, and the pension. So 6,400.9. Total liabilities equals total current liabilities, H21, plus total long-term liabilities, H25. So total liabilities should be, make it a little bit bigger, 10,081.9. And finally, liabilities and equity equals total liabilities plus total equity. We should get liabilities and equity of 16,868.7. Yes. So the total long-term liabilities are the sum of the three items above. Long-term borrowings, other long-term liabilities, pension liabilities. Add the three up. Okay? So, very important next step. We must have our balance sheet balance. If our balance sheet doesn't balance, we'll never have a valid model. Okay? So, I'm going to show you how to get a balance sheet to balance in your forecast. This is the important step. Go to cell H15, which is total assets, equals cell H32. Now your balance sheet balances. Okay, so we've crossed that hurdle of the balancing balance sheet. We've forced our balance sheet to balance sheet. So the assets equals the liabilities and equity. Now what that infers is that everything in the assets has to add up to that number. So that infers something called, in finance, a plug. So we're going to plug or solve for one item that actually gets all of the assets to equal that number. The plug in the model is excess cash. All right? So excess cash is the plug. Everything else we know, and then we'll solve for excess cash, and we have to get the right excess cash to get the balance sheet to balance sheet, and not have a circular reference. And again, I'm going to show you how to do this. So let's come back to the other balance sheet items. There's two left outside of excess cash. One is operating cash. If you go back to the assumptions tab, one of the assumptions on the assumptions tab is operating cash as a percentage of revenue. We've arbitrarily set it to 2%. That's 1 week's worth of sales. Now again, we could change it at a later date, but right now we're leaving it at 2% of revenue. So here's how this would apply. We go to our balance sheet. So for 2019 equals, from the assumptions tab, operating cash as a percentage of revenue times, from the income tab, 2019 revenue forecast, H3. So operating cash, $340.1 million. Okay. Now you'll notice that I put operating cash on the assumptions tab. I didn't put it on the ratios tab. So it's not a year-by-year forecast that changes for operating cash. Because the general idea is whatever operating cash is, you have to keep that amount regardless. All right, so that's why it's one number. But here's the thing. When I copy and paste it, that's going to cause a problem. Because if I copy and paste across columns, then basically B3 becomes C3, D3, E3, F3, and I don't have it. I don't have that. So in Excel, I need assumptions B3 to be what's called an absolute reference, which means no matter where I copy it, it will always refer to cell B3. To do that, I put in front of the B what's called a $sign or a string, and in front of the 3, a $sign, shift 4. So after the exclamation point, before the B, a dollar, and before the 3, a dollar. So by putting in $sign B, $sign 3, I am telling Excel to make this an absolute reference and copy and paste. Never change the relative reference. Always use this cell. Okay? So they'll change the income cell as I move across, but it won't change the assumptions. The final one is goodwill. Goodwill comes from acquisitions. And again, here's what I know about goodwill. I can't predict if Parker Hannifin's going to do acquisitions. I just don't know. And even if I did, I don't know how much they're going to pay for them and how much goodwill is going to show up. So I can't forecast that. Now, realistically, all the academic studies show that acquisitions are NPV negative. The average acquisition is slightly NPV negative because most companies overpay. So I also know that if they do acquisitions, odds are it's probably not going to change the valuation too much. If nothing else, it'll make it lower, not higher for most companies. So for our purposes, we're going to leave goodwill alone, equal the previous year. Now, here's the other accounting change that happened a while back, which is basically the accountant said you no longer amortize goodwill, you impair goodwill. So again, some of you will work for a big 4 accounting firm, and they'll send you on impairment tests to figure out how much goodwill changes. And to be honest with you, you're kind of wasting your time. Because from a valuation standpoint, goodwill impairment has 0 impact on cash flow because it's not tax deductible. So essentially, it's just pushing paper around, right? So every year, a company does an impairment test to say, is what we paid too much? If so, write it down to a more realistic level, and they'll make a paper transaction. But it doesn't affect cash flow. So for our purpose in valuation, it's not going to affect our valuation because we're doing cash flow valuations. So again, we're going to kind of leave it as it is, and we're not going to worry about impairments in our model because, again, has no impact on cash flow. So now that we've done this, the last item that's left is excess cash. Okay, so here's how we plug or solve for excess cash. So if you put your cursor in cell H5 on the balance sheet, equals H15 minus everything else. So minus H4, operating cash, minus H6, accounts and notes receivable, minus H7, inventory, minus H8, other current assets, minus H10, long-term investments, minus H11, net fixed assets, minus H12, goodwill, and minus H13, other long-term assets. If we've done it right, we'll get 751.3 of excess cash, and you won't have a circular reference. And now we can just make our balance sheet tidy. So if we take current assets, which is H9, equals the sum of the 5 items above. So from operating cash all the way to other current assets, H4 to H8. For long-term assets equals the sum of long-term investments through other long-term assets. The 4 items above should be 10, 7, 47.9. And by the way, if we were to add the current assets plus the long-term assets, we should get exactly the same total assets that we plugged to equal the total liabilities and equity. Now this is just a step that's a check to make sure that I didn't screw up, but basically that's the point. If I plugged correctly, all my assets should add up to this number, and this number was, remember, set equal to that number. Okay, so I don't need this here. That was just a check to make sure I didn't screw up. Yes? It's basically H15 minus everything else that's not a sum. So minus H4, H6, H7, H8, H10, H11, H12, and H13. All the other current and long-term assets. Okay, home stretch. So final step, take column H, your balancing balance sheet that you just built, copy it, and paste it out to column M. Don't drag, by the way. Never drag in this class. Paste. Right-click, paste. And you now have balancing balance sheets going out to 2024. The reason why dragging is bad is Microsoft wants to be your friend. And it will sometimes, when you drag, say, aha, friend, I'm going to make your life easier because it looks like you're trying to create a series, so I'm going to turn your field into a series to make your life easier. But your friend didn't tell you that he did that. And it's going to piss you off because then you're going to have a balance sheet that's like, this doesn't make sense. Something's really wrong here. My numbers are off by a few dollars. I don't know why. And it's because you dragged. Okay? So I'm just telling you, to prevent a lot of frustration later, don't drag, because when Microsoft arbitrarily identifies numbers as a series, it doesn't tell you that it did it, and it just starts filling them in with 0, 1, 2, 3, 4, 5. And then suddenly your numbers are off by a little bit, buried into the model, and you can't understand why your cash flows don't balance, and you'll spend hours and hours frustrated. So, pro tip, don't drag. Okay, I know it's convenient, I know it's cool, but sometimes it's that 2% of the time when Microsoft makes it a series that it will completely frustrate you. Copy, paste. Okay, that doesn't happen if you do that. So very quickly, you should have a balance sheet balancing through 2024. If you want to check your math, 32101.7. That should be your assets in 2024, if you've been following along. Okay, now for the cool thing that didn't happen to you on your midterm exam. Let's go to TFI. Take 2018, select column G, copy the whole column, and then select H through M and paste. You'll need to do relative references for years, equal previous year plus 1, and you'll need to copy these years forward through column M, 2024. but you now have balancing forecasted TFIs going through 2024. And again, if you want to check your math, 22,723 should be the 2024 TFI. If you go to the TII, the next tab over, select column 2018, copy it, go to column M as in Mary, mouse problems here, go to column M as in Mary, paste, you now have balancing TIIs going through 2024 equals previous year plus 1. Make sure the years are in there. Go to your CFI. Take column 2018, copy it. Again, go to column M as in Mary, paste it. This one actually did have the relative reference in that formula, but here's the point. You now have balancing CFIs going through 2024. Again, if you want to check your math, 499.1. Economic profit beginning a year. Again, select 2018. Go to column M, paste, equals previous year plus 1. And we now have balancing economic profits based on beginning of year, 1989, going through 2024. And the final tab, economic profit based on end of year. Again, copy, paste to column M. Equals previous year plus 1. Copy, paste. And you now have economic profits based on end of year, 1852 is the last year you're looking for, going through 2024. If you've gotten to this point, if you have those numbers, so again, check your EPEOY 1852, check your CFI for 2024. It should be 499.1. You're done for today. This is the place that you need to get to, and these are the numbers that you need to get to match. It is at this point that we will pick up in our next class and continue on with the building of the Parker-Hannifin model, and we'll then start turning this into a valuation. Yes? You're also, well, put it this way, you won't get to that CFI without getting this TII, but the TII should be 3374.8 in 2024. Yes, sir.
When we do this, can we download the file that you made on Elms and then just build it from there, or do we have to start from scratch?
No, I want you to download the file, just like I started at the beginning of class, and if you followed along just like I did on this file, this is where I need you to be today. And I need you to get here by Wednesday, because here's the point. On Wednesday, and I'm not posting a solution. So we're going to start right here in our next class, and we're going to keep building from this point. And then homework 6, which is due a week from today, is where we end up at the end of class on Wednesday. Replicated is what homework 6 is. The good news for you is if you're able to finish that in class, you're done with homework 6 on Wednesday. You don't have anything more to do between then and Monday. If you're done, you have to get there by Monday at 10 a.m. And that's the file that you need to submit. Okay? So before you go running off, one last point, because I gave the last class a preview of a midterm 2 question that a lot of people missed in a previous semester. I'm not saying I'm going to ask it again, but there's a high probability I could. But I want you to look at the CFI. And this is the difference between midterm 1 and midterm 2. Midterm 1, you had to get the 499.1. You had to get it to balance, and you had to do the right statement. But here's the thing. I want you to understand this. Why between 2019 and 2024 did the CFI not change for Parker-Hannifin? You notice it's 499.1 for all 6 of those years. Why didn't it change? Because you can clearly see, if you go to the income tab, that they're growing. Sales go to 40 billion in our model. The EBITDA is growing and the free cash flow is growing. So why isn't the CFI changing? A little conceptual understanding of CFI. Why does it stay at 499.1? Anybody have any idea? Yes.
Does that have anything to do with how the debt has stayed constant the entire time?
It has everything to do with that. That's part of it. The debt stayed constant the entire time. What else stayed constant on the financing side? Do we change the preferred? No. Do we change the dividends? Do we buy back or issue stock? Do we pay off any of that debt? Do we change the interest? So if you think about it, the cash flow that we're actually giving to investors didn't change in all 6 of those years. That's why it's not changing, because we're not changing the distribution of cash to shareholders. We're leaving it constant. So here's the thing. Where'd all the cash go? So if we had a bunch of free cash flow, because free cash flow didn't stay the same, you can see it went from 600 million to 1.6 billion. So free cash flow is growing every year. So where'd all that cash go? Where does it show up?
Excess cash.
Exactly. So here's the key. And this is a subtle but very important point. A lot of people get caught up in the, I made cash, how do I pay it out? Do I increase the dividend? Do I buy back stock? Do I pay down my pension? Do I pay off debt? And to some degree, it's a big debate about how I distribute the cash. We're staying above, in this class, that what I call religious debate. What we're showing you, and you can see what he just said, if you go back to the balance sheet, or TFI, we can see that we have 4.1 billion of excess cash, which is cash that can be distributed. So we're staying one level up. So instead of saying, here's how much they're going to pay back in dividends, what we're saying is they have 4.1 billion that they can distribute. We don't care how they distribute it. It doesn't affect the valuation, right? The valuation is unchanged on how they distribute. But what we did forecast is how much is distributable, okay? And that's where the excess cash comes in. So we are forecasting a potential payout. That is the payout that Parker Hannifin could pay. And realistically, they're not just going to sit on the cash and not increase the dividend if they really made this amount of money. So that's the point. We don't have to tell them whether or not it's a dividend or a share buyback. They can determine that later. And by the way, those two don't actually affect the valuation. Okay? So therefore, it's independent of the valuation. So we stay out of something that's a lot of work that actually has no impact on the valuation. But that's the point. We can go to the company and say, if you hit these numbers, here's how much cash that you are going to have available to distribute. And then you can have the conversation about the most efficient way for you to distribute it to your stakeholders. So again, a little subtle point, but that's actually why I mentioned excess cash is not only a plug, excess cash is the proxy for the payout. That is where we're holding the excess free cash flow above and beyond what's already forecast in the model. Now again, you want to get granular? You can get granular. You can start playing around with the dividends and you can change your CFI, right? But it won't change the valuation, and you can quickly see that within the model that we're going to build. But again, a little bit of advance, but this is what I mean by once you start to understand what the statements actually tell us and how the valuation works. But we'll get there one step at a time. So again, if you've gotten to this point, great. If you haven't gotten to this point, this is being recorded. The video will be posted on YouTube later today. Get to this point, come with this file ready to go on Wednesday. Again, no sharing of files. You got to build it individually. And then we'll continue on and do the valuation part based on the data that we just put in here. Okay? See everybody on Wednesday.